Hello, my name is George Bell, an investment analyst here at True Potential. And today I'd like to pick up on a topic which has been widely discussed in the tabloids, and that's President Trump's implementation of import tariffs on $50 billion worth of Chinese goods. This has been creating concern for businesses exporting manufactured goods and is partially responsible for the global slowdown underway in economic growth. Falling business confidence is a key component of the global economy, and the crossover to the real economy is meaningful, but there are several tangible bright spots which also need to be considered to form a balanced view. Global economic data in the service sector has been very positive, a trend which is supportive, particularly for employment prospects and wages, and China, which is still considered a developing country, is also evidencing these positive trends. Unemployment in China is now at historically low levels at 3.8%. Business sentiment is back at its highest level in 7 months. Foreign direct investment into China increased 5.5% year on year. Therefore, the area of greatest angst globally and particularly in China is manufacturing. Activity in this sector and the leading indicators have been weakening since March last year. Given the negative backdrop, the Manufacturing Purchasing Managers' Indices, are often referred to as PMI, are being scrutinised. Business sentiment indices for manufacturing activity across the globe in general have fallen below 50, indicating contracting or falling activity. And this has also been true for China until recently. PMI data from the Chinese National Bureau of Statistics, which covers large Chinese state-owned enterprises, showed an increase from 49.2 to 50.5. Anything above 50 represents expansion. This upbeat data could have easily been dismissed as state-influenced, but the Caixin Market Manufacturing PMI, which is privately constructed and covers small to medium private companies, staged an even larger rebound from 48.3 to 50.8. Well, it's early days to claim a sustained turnaround is underway. 3 main factors are considered responsible for the rebound: a pickup in buying activity and placing of new orders, 2 key components of the PMI. Improved sentiment around progress in settling US-China trade negotiations. Fiscal stimulus implemented earlier to counteract the disruptive effects from US-China trade dispute talks. A more relaxed financial environment facilitates and even stimulates increased demand for borrowing by small and medium-sized enterprises. Finance fuels their growth and promotes confidence, and as we know, confidence creates more confidence. This positive shift is also picked up by the investors. So what happens next? Well, the fiscal stimulus, in tandem with a more relaxed landscape for foreign investment, are supportive for Chinese manufacturing sector and for China's economy as a whole. Previously, it was important to get a sense of balance between weakening manufacturing and resilience in the labour market. Now there's some hope that manufacturing may be forming a base. It's too early to say if this is sustainable, but the snoozing red dragon seems to be waking up again, and this is good news for the global economy too. Thank you for watching.